Okay. Thanks, HP. All right. Well, that's a good introduction. Thank you. HP, you want to come up and introduce me? All right. So I see everybody's grabbing their seats. So glad everybody's able to make it tonight. Hopefully you get a lot out of it tonight, and I put some good work into trying to put together some good material, as I always do. So hopefully you appreciate it, and I'll share with you some personal goings on from this year and last year as well. But yeah, excited to get started. 2024 was a pretty good year, and so we're entering a different year, obviously. And you might remember, I always have a theme every year. A one-word theme for this presentation, and I'll kind of go through and talk about the last few years very briefly, and I have a couple of quick points on what happened over the last couple of years and kind of what we predicted and what actually happened. And then we'll talk about this year, which I'm sure most of you are most interested in hearing about, of course. So I will say that you probably know from years past that I generally talk about how politics doesn't matter, right? You know, how who gets elected, things like that. So we always ask everyone, send in some questions on, what you want to hear more about. Well, guess what the overwhelming number of questions were about? I think you could probably figure that one out, right? So I will break from my usual norm and talk a bit about that. There's a particular article about the three faces of Trump that I read that I thought was pretty funny. So you'll hear from that directly. So yeah, but with that, we'll go ahead and get started. Here's our little disclosure. So past returns are not guarantees of the future and all that stuff, right? But here's our annual themes that we had year by year. 2022 is the year of volatility. That's what we called that. And remember, I do these in January, so it's obviously forecasting. So 2022, we were pretty spot on there with volatility. Opportunity was 2023. And then last year was distraction. Okay, so we'll talk through these a bit here. So 2022, just recapping, you might remember that year, but hopefully you've forgotten most of it. Was a pretty rough year for the market, right? Both stocks and bonds were down dramatically. So as I said in the beginning of the year, stock market valuations were going to be an issue, inflation was going to be a problem, and really avoid speculation, okay? And lastly was avoiding bonds, all right? So that's been, when interest rates were at zero, it was not a good idea to have money in bonds, because when interest rates go up, what do bonds do? They all fall, right? So just kind of going through some of these. This was the price to earnings ratio back in 2022 when we did this presentation. And you can see it was at 25.24, which is historically high, okay? The average is 15 to 16, all right? So you can see in the chart, though, it actually had declined right there. And that was the beginning of the decline because it went down from there, right? So we knew the stock market was expensive, which was one of the reasons why we figured 2022 could be a year of volatility, i.e. that's kind of a nice word for losing money, okay? I said avoid speculation. So coming off of COVID, remember what some stocks were doing? Everything was going online. So Zoom and DocuSign and all these things. And those stocks went through the roof. Peloton's an example I like to talk about, right? Everybody was going to buy a Peloton bike in the U.S. and get that. Every single person was going to get the $30 subscription because gyms were closed. Well, there's a problem. Gyms reopened, so that was a little problem. Besides, they started catching on fire and things like that. But you can see what these stocks did. Like Peloton stock down 95% from its peak. Okay. The other ones, these are not necessarily bad companies, just a bad time to buy the stock, right? It's speculating when things are just continually going up. So, Zoom and DocuSign I mentioned. People are using those like crazy now, but that doesn't matter. There's a difference between a good company and a good stock at a good price, okay? So we avoided that kind of speculation. Of course, we anticipated inflation would remain high in 22, which it did. 2023 predicted it would start to decline, which it did as well. Now, the other thing was bonds. So I had this quote, which I've mentioned a bunch of times. If you're familiar with Bill Gross, he's kind of like the Warren Buffett of bonds. They call him the bond king. So he ran PIMCO Investments for a number of years. The two PIMCO bond funds were the two largest mutual funds in the world, okay, when he was in charge of them, okay? Then what did he do? He retired out of the blue. Why did he retire? Because interest rates were at zero and he was handling trillions of dollars of worth of bonds. He knew interest rates were going to go up and he knew that the bonds were going to crash. So he didn't want to be at the head of these mutual funds that crashed. So he retired. And you can see here in September of 2021, he said, mutual funds that buy bonds belong in the investment garbage can. That's what he did. So kind of interesting there. But that's, in fact, when interest rates went up in 2022, that's what happened to bonds, and they had a significant crash. Also, the interest rates went up extremely fast in 2022, and increasing interest rates are what drive bonds down. So that orange line right here, that's how fast they rose interest rates. It's the highest they've ever done it. Okay, and I'll talk a little bit about where interest rates are today, and we see them declining, but not as much as people thought earlier. About a year ago, people thought they were going to be declining much quicker than they actually are. Okay, so they're still staying relatively high today. Now, 2023 was going to be the year of opportunity. Okay, things had gone down, but there was actually a lot of positive tailwinds that we had for the stock market. People were pretty scared. When people are scared, that usually means the market's going to go up. Okay, it kind of does the opposite of what people's emotions do. All right, so we had a potential strong market because of inflation improving. Strong job creation, and year 3 of the election cycle. So like I said, I don't like to necessarily talk a lot about politics and if it's, Democrat or Republican, but there's absolutely something to the election cycles and what happens in the year, the year of the election cycle. And year 3 is typically the best year in the election cycle, okay? There was also high interest rates at that time, which allowed you to get more fixed investments at a good price. So here was as we said, inflation was going to be coming down. It peaked and then it was declining. So this is pretty much how it ended up going. Was this prediction was pretty close. Okay, you could see that it was declining because when we look at the 6 month in June, the 6 month was 11.2, and the 6 month was at 1.9 in December, just 6 months later. So you can see how much it really declined because they increased interest rates, which actually got inflation under control. Okay. We also had good job creation going into 2023, which created opportunity. Market returns average about 20% in that third year of the election cycle. Okay, and the markets did go up just over 20% in 2023 and actually 2024 as well. So 2024 was the year of distraction. Basically what that meant was the market is going to keep going up even though there's all these distractions. Okay, and that was mainly the election because everybody likes to, talk about, well, I don't think everybody likes to talk about it. I shouldn't say that. But the news throws it in our face all year long during the election, right? So it's hard not to think about what's going on with who's going to get elected, right? But we had a recovering economy and we had falling interest rates at that point. So those were tailwinds. But international conflict and elections, I talked about that potentially happening. This is just some data that we put up with unemployment dropping and things like that, which was a strong indicator for the economy. Interest rates declining. So this was the forecast of what interest rates would do. Didn't go down quite that fast, but they did decline, which helped the stock market as well. Okay. Now this is actually Fidelity's headquarters. So if you remember not last December, but the December before that, at the end of 2023, I actually was invited to Fidelity's headquarters where they had a bunch of presentations from experts. And one of those presenters was the former head of the Middle East for the CIA. And after hearing him speak, I was terrified. Can you imagine having that job, being the head of the Middle East for the CIA? So he talked a lot about what was going on in the Middle East with conflict, but was actually really disturbing was what he thought might happen with Putin and Russia and Ukraine, and that might escalate farther. Fortunately, none of that happened. So fortunately, that didn't become a big distraction. It did not escalate, although it's obviously not over. It's certainly not solved. But I'm happy to say we didn't have a lot of distractions regarding conflict in 2024. So that was good. But yeah, election cycles matter. Elections results do not. So that's a slide from last year. And you can see that just from this. Obviously, blue under Democrat, red under Republicans. Depending on the time frames you look at, the returns between the two parties are basically just about identical. Okay, depending on the time periods, sometimes you can actually say it's actually been a little bit better under Democrats than Republicans, which people usually think it would be the opposite. But it's pretty much a wash. Okay, overall. But again, last year was still going to be a strong year because of being the fourth year of the election cycle. Year 2 is what we're worried about, which is next year. Okay. I just gave you a little hint. So 2025, what are we seeing for this year coming up? So what do we think the word is going to be this year? The word for this year, euphoria. Okay, euphoria is what this year is. Now, what we're really talking about here is the stock market's probably going to go up regardless of data and regardless of everything else. We are at the stage in the market where there's excitement, there's thrill, and then there's euphoria, and then what comes after that? So I think we've still got room to run in the market. The market tends to get more expensive than it should before it starts to drop. And that's where we are right now, is the market's expensive. However, I think it's going to keep going up. All right. Again, next year is probably going to be a little bit more of a challenge. To put this a little bit in perspective, so some of the most recent economic data from one of the large investment banks has returns this year at 7%. So not having double-digit returns. We've had a really good, strong couple years. Returns won't be as high as the last couple years, okay? But not anticipating a big crash. Okay, but what do they anticipate the long-term next 10 years look like? The next 10 years is forecast at 3% average returns. Okay? So the reason why that's being forecast is because think about what's happened since 2008. The stock market's had a historical climb with some, kind of COVID in between. Okay? So that's put the market at a pretty expensive point. So it's going to be a more volatile next 10 years than what we've seen. More recently, just things have gone up a lot. Okay. So to kind of talk about some of these specifics behind this and what the euphoria is coming from, the tailwinds, inflation is kind of normalized now. Interest rates are still going to continue to go down a little bit, but not that fast. Well, after yesterday's stock market, the Fed might say something different tomorrow, but we'll see what happens. But stock inflows are another thing, and again, the election cycle we're still in positive time frame here for that. But then valuations in the market and over-concentration are going to be things to take a look at. So, and then we of course have the reviewer request to talk a little bit about Trump.
Stock inflows?
What's that?
What do you mean by stock inflows?
And I'll get to that, HP, but basically what it is our stock market is now very driven by people putting money into their 401k. Okay, so the stock market is going to be more expensive on average than what it has been in the past because people are so involved in the stock market. Everyone's savings is all connected to the stock market. And most people are disciplined enough to keep putting money in to the market through their paycheck rather than stopping it when things go down. So they continue to dollar cost average and just put money in whether it's up or down, okay? So that money going into the market actually helps to keep it up and actually drive it higher, okay? So that's gonna make when we look at the valuations in the market where it's historically 15 or 16 for the price to earnings ratio, higher is more expensive, right? I'm going to get to this, but we're over 30. I did this snapshot on Friday. What is about 30.5 was the PE ratio. Again, 15 to 16 is the average, so that's expensive. The 2022 slide I showed you was at 25. Okay, it was at 30.5 on Friday. Today, after Monday, after Monday happened, it went down to just about 30. So it lost about a half a point there, just in a day. Okay, so it got a little cheaper, I guess, if you can think of a positive of a stock market decline. But here's some things that we see happening this year. Inflation, with keeping interest rates high, inflation has really come down. And now we're in a really good spot overall where it's about 3% right now. So you can see here it's been 3%, 2.9, 2.5, 2.4, 2.6, 2.7. It's a little bit under 3%, which is really good. Now the Fed's target is 2% to try to get it down to 2. In my opinion, that's a little bit greedy to try to drive it down that much. But the forecast, really what it looks like, is about 2.5 by the end of the year. With declining, with them slowly decreasing interest rates. So when interest rates go down, that's usually positive for the stock market, just because it allows companies and people to borrow money at cheaper prices. And so when you can borrow money cheaper, you're going to spend more. Basically the idea. Okay. What are we good at here in America? We're good at spending money, right? They can reduce interest rates all they want in Japan, and it almost makes no difference because they're savers in Japan. So they've kept interest rates at 0 or negative. Actually, last year Japan finally had positive interest rates for the first time since the 90s. Okay. They just keep interest rates at 0 or negative in Japan typically to try to encourage people to spend money rather than just save it. So it's kind of just a different way of looking at things. But the U.S. is number one in something, and spending is one of those things. So yeah. Here's what we see happening with interest rates. Here is the target. We're at 4.25, 4.5. Here was the target earlier in September, as most people thought is going to be declining like this down to 3%. Okay, so continuously ratcheting down interest rates. That's changed. Now it's only declining just a little bit more. Okay, that's sort of what the Fed is putting out there with how they're speaking about interest rates, that they're not going to be pulling them down very quickly. Okay. The one problem, well, there's multiple issues with that. It does keep the economy, it kind of keeps a lid on the economy when they keep interest rates up. But the other thing, of course, is debt service. So how much debt do we have in the country today? I'll show you the screenshot later I took last week. But yeah, it's 36 trillion, right, Scott? Yeah, 36 trillion is where our debt is now, okay? We have to pay interest on all of that. So that's an issue. And I'll get to this a little bit later, but that's where we know, we know interest rates we know that taxes are very likely to rise in the future because we have to pay for debt in some way. And if you look at the amount of debt service that we have to pay, it's getting pretty out of control, okay? So that's an issue. I'll show you the slide on mandatory expenses versus the ones that are discretionary for the government, and it's not too good with how much is mandatory, okay? But anyway, inflation is under control, so interest rate decreases will be, there will be fewer this year, okay? Here's kind of what HP asked about was people putting money into the stock market. So much of the stock market is just driven by people putting money into it these days because our retirement and our long-term livelihood for investing is mostly stock now, okay? So you can see here, this is the percentage of people's assets that is in the stock market as a whole, and it's basically the highest it's been in 25 years plus, okay? So there's kind of two schools of thought you could say here. It's like, well, people already have a lot in the stock market, so they're not going to put more in. Like, that's one stance you could have. I don't really subscribe to that one. I think it's more that it's just showing how connected we are to the stock market just as a country and putting money in. Okay, so that's that part. Again, we have the fourth year in the election cycle happening, or I'm sorry, the first year in the election cycle happening now. Which can drive things forward. Now, it doesn't matter as much who gets elected. However, I thought, let's look at something a little bit different. What if we look at something politically where, what if an incumbent gets reelected or not, or the incumbent party, I should say, and what happens then? So if this is the market returns, and I'll maybe focus on the market returns after the election, because that's where we are right now, right? So the blue is where the market would be if the incumbent party won, okay? So if the incumbent party is the winner, actually there's a little bit higher returns than if they lost right after the election, okay? But longer term, it doesn't do quite as well. You can see after 1 year, it's 4.7% on average, compared to if we have a switch in the incumbent party lost, then it's 8.6. So it actually tends to do better when we have a new administration for whatever that's worth, okay? All right. Here's the other thing that happens, though, is it might be higher returns, but the volatility is actually a lot higher, too. There's more volatility in the market as we have when we have a new administration. So, after 1 year, we've got 17%. With the volatility, and after 9 months, it's 17 compared to 12. So it's going to be a little bit more of a rocky ride when we switch administrations. Okay. Now, talking about a potential issue here, or a couple potential issues that could derail this euphoria, right? So again, I feel that where we are with the markets, they're going to keep going up for this year, just because there are tailwinds economically and with interest rates. And just people's general sentiment being positive, it's gonna push things up. But here's what could potentially derail that. And that is stock market valuation, as I've mentioned a couple times here. You can see we're now at 30.59. That was on Friday. Again, it went to 30.09 when I looked today before. So 30 is expensive compared to the average of 15 or 16, as we've been talking about. Okay, you can see when it hits this 30 line, it's happened 4 times in the past. What's happened after it hit that line every time? We see big drops, right? We see that 2000 big one here. This is 2008 where it kind of went off the charts, and then that's the 2020, right before 2022, okay, when that started. All right, so we're now in this, 5th time it's hit over 30. So that's a warning sign. But again, the stock market can get a lot more expensive before it goes down. And stock market valuations, the valuation of the stock market doesn't drive the stock market down. Okay, it just gives us an indicator that it could happen. All right, but there needs to be an impetus for that to happen. There needs to be a trigger, something that happens that causes it. And this is likely to be what they call a black swan event. So this will be something unexpected that happens. Okay. So when we have a war or something like that, we're not expecting, and obviously COVID's a pretty obvious one. Nobody really saw that one coming, right? So if the market's expensive, that could be an issue, okay? Here's another problem. The stock market is extremely concentrated. Last year I actually talked about the stock market and looked at, you might remember, we looked at the top 10 biggest companies in the country going back to the year 2000. And then comparing that to today, or a year ago, right? There was only one company that stayed in the top 10 from the year 2000. Does anybody know what that company was? I heard it over there. Microsoft. There you go, Microsoft. Yep, Microsoft is the only one that stayed in the top 10. Okay, all the others, GE was actually the #1 biggest company in the country back in 2000, okay? Looking at that. So there's basically the top 10 can shift over time, but there's a problem when you have too much of the top 10 all in, when they become too big, which is basically where we are right now, okay? The top 10 biggest companies now are actually, it was a little bit higher, but they're 36% of the overall market. And that causes issues. You might have heard of, and we talked about this a little bit last year, the Magnificent Seven, these top companies that have done really, really well. And they've done well and grown. However, there's also potential that will not continue. And I'll show you some statistics here. So we talked a bit about this last year, but just to continue on the same trajectory here, the overall S&P 500 last year was up 23%, year before 24, okay? But if we took out the Magnificent Seven, so we took out the 7 companies that did the best basically, what would the returns have actually been? 4.1 and 6.3, okay? So it's all being driven by a few companies, all right? Yesterday, that started to turn around. You see what happened to the stock market yesterday? It had a big decline. What has driven these 7 companies to go skyrocket is AI, right? The assumption that AI is going to completely change our lives, which hopefully it will, but how will we actually profit from that through the stock market? That's the question, okay? Anybody remember the year 2000? Remember what happened with the market?
.com.
Yeah, that was the .com bubble. Did the internet change the world? 100%. But did those particular stocks? Not necessarily, right? A lot of them went to zero, okay? And the same thing, I'm not predicting this is going to happen, but the same thing could happen with AI. There's been so much buzz about it, and absolutely it will change the world, but will it actually be profitable for companies is the question. And if you didn't read the news yesterday, because this is all pretty new, right? Basically, there's a Chinese company that came out with a new AI app, essentially, and they built it for $5 million. And it basically works just as well as OpenAI that they spent, trillions to, however much money to develop. Okay, so somebody just came up with this for a very inexpensive price, and of course it came out of China. So everybody's, freaking out that our China's going to beat us at our own game. Okay, so that's where the market's suddenly gotten a little bit nervous, and certain companies. What's been the hottest stock over the last couple years? NVIDIA. How much did NVIDIA go down yesterday?
17%.
17%, that's right. Okay. 17% in one day. That's not, that's pretty volatile, I would say, right? Yeah. So without, those companies have driven a lot of the gains because they actually have had good profits overall. All right, when we look at, but let's back up, and this is actually a slide from last year, okay? So last year when we looked at this, it was the same idea. The earnings on the S&P 500, the top 7 stocks drove the earnings, and that caused the market to go way up. But I also talked about the year before, it kind of made sense they had to go up because they had to recover. Look what the top 7 did in 2022. They went way down. They took huge losses, okay? So when you see a huge gain after a huge loss, it doesn't always mean as much, right? Right, if we have a 50% decline in the market, how much gain do we need to get back to even? We need 100% return, right? So it can sound great when we have this, when we have a 60% return or something like that, but if you're coming off a 30% loss, we're just getting back to even, right? So always keep that in mind. And the reason why I mention that is because if we do have a decline, which I think is not unlikely to happen in sometime next year, those companies that have an extremely high valuation are going to be the ones that drop more. Okay. So many of the predictions coming out now are that it's going to be what they call a broadening of the market. Okay, so it's not going to be just these biggest companies that are going to do well. It's actually going to reverse. It's going to be the other companies, the smaller companies that do better. Okay, and looking at this shows you this. So this first kind of whatever color that is, that taupe or whatever, that's the Magnificent Seven. That's the earnings growth was 34% back in 2023. 2024 is about 30% as well. But the earnings growth they expect to decline pretty significantly going into this year. Okay. Earnings growth was actually negative in 2023, on the S&P 493. So that's all the other S&P companies with the exception of the 7, right? And then there's the Russell 2000, which a lot of people think is the top 2,000 companies, but it's actually not. It's actually, you eliminate the top 1,000 and then you take the next 2,000. So it's actually the small cap index is what the Russell 2000 is. It's the smaller companies. So we're eliminating the top 1,000, okay? So you look what's happening here with the earnings growth. It was better in 2024 because it wasn't negative, but look what they're anticipating here. You know, really big earnings growth for smaller companies. So we want to be shifting more toward smaller companies rather than just relying on the large ones, which has worked well, you know, the last couple years, but is likely to not work as well moving forward. Okay? All right, so you want to hear about Trump? So I pulled this pretty much directly from an article, which I thought was pretty good and I got a kick out of it, so I'm going to share this with you. It's really about the 3 sides to Trump, and depending on how you view him, you'll be like, oh yeah, that's the one, you know, depending on what your opinion is, okay? So the first side of Trump is businessman Trump, okay? And who is businessman Trump? He's the guy who favors deregulation and tax cuts, and he's going to drive the economy higher because he's going to lower interest rates, he's going to allow more energy, and, you know, wants a big stock market, okay? So he wants things to go up. So that's businessman Trump. What's the next one? Populist Trump, okay? He wants to deport migrant workers. He wants to tax imports to the hilt, enact protectionist policies that could potentially depress growth, raise costs, and potentially be an issue for inflation, okay? And then you've got, you know, we're kind of at one side of it, and then sort of in the middle, and then the other one is Madman Trump. Okay, and these are not my words. Again, this is from an article I read, but I thought it was kind of funny. So he's the bomb thrower who threatens to invade Greenland, annex Canada, reclaim the Panama Canal, and do all those things. Okay, so which one will we get? And this is again directly from the article. Can all 3 of these persona exist within one president? It's Trump, of course, right? So, yeah, I mean, it is really hard to predict which one we're going to get, and these all have dramatically different results for what the economy does and that. So, you know, overall, I think it's a little bit of all of this, okay? And some of his, you know, talk about what I believe the tariffs, a lot of the talk about tariffs that he has is sort of a negotiation tactic where it's saying, hey, we're gonna do this in order for him to kind of scare people and kind of be a bully, right? And actually that can work as a negotiation tactic. So that's kind of what I think is sort of happening with that side of it, okay? But I don't think it's going to be any of these extremes, right? Overall, one thing we do likely expect to happen is for the tax laws to stay intact, okay? So I've talked a lot in the past about the tax laws are expiring at the end of this year, right? So when they lowered taxes back in 2018, they lowered taxes and they had to put an expiration date on it. And the expiration date was the end of this year, okay? So basically what's set to happen is at the end of 2025, the taxes will go back to what they looked like in 2017, okay? So a lot of people in here today, like married couples, 22, 24% tax bracket is where a lot of people fall, okay? Most of those people will go up to 28 and 33, all right? And it's kind of the same trajectory for single people as well. It's not that much different. So that's what's set to happen, okay? And my thought behind this was, okay, it's already written into the law. So all they have to do is let it expire, and you know, then blood on nobody's hands, they didn't raise taxes, it just happened on its own, right? Because all Congress would have to do is nothing for taxes to go up, and are they pretty good at that? Yeah, right. Most everybody can agree with that, right? So I've been kind of admittedly running under this assumption that that's what might happen. I don't know if that's what's going to happen now, to be honest. I think actually Trump is going to want to keep the tax breaks in place. That's what I think will happen. But there hasn't been any real announcement on that yet, whether it's an extension of what we have today or it comes across as a new, kind of a new thing. He's talked about not taxing tips and stuff like that. So if you can figure out a way for your neighbors to tip you, and somebody's going to figure out some kind of business model that takes advantage of that, I know. But and part of the point here is there's been a lot of urgency to try to take advantage of the tax laws while they're lower, right? Taxes historically low right now. And I have to just go through this again because I want to put it in perspective for everybody, how low taxes are, because I know nobody likes paying taxes, right? But this is the best example I can think of, is if there's a married couple that's earning $250,000 a year, what tax bracket would you be in today? At $250,000, you'd be in a 24% tax bracket, okay? You actually don't hit the 32% tax bracket until you're at like $393,000, something like that. It's getting closer to $400,000, okay? So the 24% bracket is pretty darn wide, all right? But if we inflation adjust this back to 1980, okay? So we're going back to 1980 and we're saying the equivalent of earning $250,000 a year. This isn't necessarily a couple who's like uber rich, right? Earning $250 a year. But if you looked at the same amount of income back in 1980, what tax bracket would that couple have been in? It's more than double. It's actually 54%. Okay? Now, admittedly, taxes were high back in 1980, but 54 compared to 24. Are you happy to pay 24% now? Okay. One of the examples that they very commonly give is the highest tax bracket is at 37% right now, okay? And a lot of people like to say, well, that's historically low, but not everybody's in the highest tax bracket, obviously. You have to be earning a lot to get to the highest tax bracket, okay? But if you are, you're in 37% today. How about 1944? Yeah, it was 94% was the highest tax bracket, okay? Only for 1 year, and then they figured out there was no incentive for people to work to make more money when you're being taxed at 94%. I might have shared with this one of the last couple of years, but Ronald Reagan used to make movies for a living, right? So there's actually one of the funny examples is he would get paid $100,000 a year to make a movie back at that time, and $100,000 is a lot of money, right? But he would only make 2 movies a year, because if he earned over $200,000 a year, he was taxed at 94%. So what's the point of making a third movie? No reason, okay? Yeah, so just getting into a little bit on taxes. So here's this example that I just gave you is kind of what I think is kind of the humorous way of looking at Trump, right? Here's more the, I would say, just more the academic way of looking at it, okay? So looking at this, tax cuts can propel the economy higher. Deregulation can be a good thing for businesses. It can increase their earnings, things like that. That's the positive side of it, just stock market optimism overall. But what could be a tailwind or what could be a headwind would be trade tensions, because if we force, if we start having all these tariffs on goods, there's going to be retaliation potentially. This could actually raise the prices for what we're paying for our goods. Okay, that's the issue there. Deficit concerns, absolutely. I'll talk a bit about that. And then just labor market tightening. There are jobs that a lot of us don't want to do, okay? So there are migrant workers who come in and actually do those jobs. If we get rid of those people, then who's going to do that work, right? That's going to potentially drive prices up as well. Again, I think that there might be a little bit that happening with Trump, but I don't think it's going to be let's go deport everybody in the country. I don't think it's going to be that extreme. Hopefully, okay. All right, here's our debt clock. So this is from the 22nd. So you can see up here, $36 trillion is where we are now. This is potentially a big issue long term because we have receipts of less than 5 trillion, but we spend closer to 7. Okay, so 1.8 trillion a year is our annual deficit. So we're going to be going up about 2 trillion every year, which is bad. This is a long-term look. You know, here we are here, but it's projected just to keep getting worse and worse. Okay. When you look at this is our overall receipts where money comes in. Deficit 1.8 billion. Then this is what we have as outlays. 62% of our spending is mandatory spending. And that's actually most of the, if we had to take away all this other discretionary spending to get rid of the deficit. So that's why it's getting to a really bleak point where it could become out of control. Okay? But we just keep kicking the can down the road. Maybe our kids will pay for it. So we'll see. But where does the spending come from? Social Security and Medicare are anticipated to just, become higher and higher expenses because, the baby boomers are all retiring, and that's where there's going to have to be a lot of outflows for, Medicare and Social Security because of that. Okay. This is comparing 2025 to 2017, and like I just gave you that example, earning $250,000 a year, you're right there in the, on the tax bracket, 24%, but you would be in a 33% tax bracket in 2017. So that's what it potentially is next year if these laws do expire. But I do think this will get extended. We've talked about in the past, this is why we think Roth conversions are a good idea, because we can actually pay in taxes intentionally now to lock in a tax rate. So if we can lock in 22, 24% now, rather than potentially paying 33 or 35 or whatever the number is in the future, to me, that's a good thing. Okay. Here's just a couple items. What happens when the expiration of the taxes, if this were to happen, what happens? It goes back to the old marginalized tax system. The standard deduction is now higher, right? They made the standard deduction a lot higher. That will go down. However, one of the things down at the bottom here is the SALT tax deduction. That was taken away. So our state and local taxes were capped at $10,000. That cap will actually go away. Okay, so more people will itemize if this does expire. Okay, but again, I believe that most of this will probably get carried over with the new administration. We might have a few extra years where we'll get this. Have these same sort of tax rates. But the SALT, I'm sure most of you will be happy to see that SALT tax deduction put back in place. But then there's no change to the corporate tax rates and no change to capital gains. One of the targets, what I think will probably happen, is I think capital gains rates are going to go up first. That's probably going to be one of the first things to go up, because capital gains are an easy thing to tax because the idea is, well, people that are more wealthy pay capital gains and people don't pay capital gains. And it's at 15% right now. Most people don't pay 20%, which historically it's been 20%. So capital gains could be going up in the future. That's what I think is one of the first targets for tax. Okay. A couple reminders here on, we're coming up on tax time, right? So by February 15th, you get your statements from Schwab and brokerage accounts for your capital gains. And so, a lot of people just ask, well, why haven't I gotten it? Because they think it comes after, by the end of January. It's actually February 15th, okay, just so you know. And the other thing is if you've done a rollover, you'll actually get a 1099-R, which shows the dollar amount of the rollover. Don't panic. It doesn't mean you're paying taxes on that amount. If you actually look at the taxable amount in box 2, it'll say 0. Okay, so you're not actually paying taxes. So rollovers are not taxable. So just keep that in mind. But here's a little tax trick that is something newer that I think is pretty cool. Okay, so but you might know I'm a nerd, so hopefully you guys think this is cool too. So here's an issue that a lot of people have is you might have owned a stock and you might end up with a whole bunch of money in this one particular stock because it's done well over time. But you might not necessarily want to sell it because what happens when you sell it? You have to pay capital gains, right? So this can be an issue where you end up with overconcentration in a stock, okay? And this is just a chart on why that's a problem. 99% of stocks will do worse than the overall index, or they're not as diversified. They'll have higher volatility. And 41% of stocks will have a permanent impairment. Basically what that means is that the stock will drop by 75% and not recover back 50% of that. So it's surprising how much one individual stock can really not do so well that people don't realize how often this happens, okay? So that's why having overconcentration in one particular stock can be an issue. So what's very cool is that there is actually a way to potentially eliminate this issue, okay? So you've heard of a stock exchange, right? So when you go to a stock exchange, you can buy and sell stocks from somebody. It's a public stock exchange, right? That's what the New York Stock Exchange is, public, okay? But what about a private stock exchange, okay? So private stock exchange is an investment where you can potentially diversify your stocks without paying capital gains. So this is how this works. You can take an individual stock, transfer it to the private exchange, okay? You have your cost basis, what you paid for that stock. That remains the same. Nothing changes when you put this in the private exchange, okay? So nothing changes with your cost basis. But over time, what happens in this private exchange is it starts getting slowly diversified. You have this investment in there for 7 years. After the 7 years, you come out with 20 to 35 stocks with the cost basis split across those 25 to 35 stocks. So you've gotten diversification of your individual stock, paying no tax in doing it, okay? So this is a pretty powerful tool that we're now able to use. So pretty cool.
Is this something new?
Yep. Yep, something new.
Kurt, when you say private stock exchange, how do we find that?
So you have to have, you can't, it's not public, so you wouldn't be able to just go and research it or get it. You have to do it through an entity like ours. Yeah, so we can go through the specifics on how it works. Yep. It does require higher dollar amounts, just so you know. So you can't just put in like, oh, I've got 50 grand in a stock. So here's a few educational I guess kind of wanted to go through. Last year I talked about the top 10 companies and how they changed over time. So in the year 2000, GE was the biggest and Microsoft was the second, and all those 9 others besides Microsoft all changed, right? So I figured it might just be good to add a little another educational nugget here. Dow Jones. Does anybody watch the Dow Jones and what the value of the Dow Jones is? So the Dow Jones, is it a good stock market indicator? I would challenge that it's not, okay? And here's why. I want you to understand kind of why this is. The S&P 500 and most index are market cap weighted. So what that means is that the bigger companies count for more, okay? So NVIDIA and Apple, they count for more in that index, all right? The Dow Jones is actually stock price weighted. So it's based on what the stock trades at. So it has nothing to do with how big the company is or how good the company is or anything like that. So what is the biggest company in the Dow Jones? It's actually Goldman Sachs. Why? Because Goldman Sachs trades for $600 and some a share, okay? Let's say they did a 10-for-1 stock split. So they were then trading at $60 instead of $600, okay? Would anything fundamentally have changed with the company except the stock price? Nothing. But now they would be number 30 on the list. Okay, so there's actually a disincentive to do a stock split when you're in the Dow Jones, okay? Can you guess, anybody have a guess, what number stock, oh, by the way, number 1 before yesterday, the biggest company was NVIDIA, and what is it on this list? It's actually number 22 out of 30. There's 30 companies in the Dow, okay? So what number does Goldman Sachs fall if we look at it on how big the company is? Where does that fall? Is it in the top 10? Do you see it there? No? Is it in the top 20? No? Goldman Sachs is actually right there at number 21. Okay? So the Dow Jones is really kind of a meaningless index, in my opinion. Okay? So I just figured it's kind of an interesting little thing to kind of learn there. All right? Another thing is, the stock market declining is a lot more common than people realize. Okay? How often do we have a stock market decline of 5% in a year? 91% of the time. Okay? We're always going to have volatility where the market goes up and down. A 10% drop happens more than half the time during the year. More than half the years. A 15% drop happens about 1 in every 3 years. Okay? And then a 20% drop or more happens 1 in every 5 years. Okay, so that's how often stock market drops are happening. So we do have to, if we're invested in the stock market, we always have to assume there's going to be volatility. There's always going to be up or down, up and down. But they say the stock market climbs a wall of worry. So as we get worried about the stock market, it tends to go up even though, things can look negative. Okay? And that's kind of the last couple years what they've been, and I think that'll continue this year until election year cycle number 2, which is next year. Okay? So we're getting closer to that potential decline. Let's skip that one. Okay, so some well-tracked news. Just some things that have been going on this year. We have a new charity for the year. As you know, we've been supporting charities for a long time here at WellTrack. And there's a couple days we do that through our Flat Kurt program, which I'll show you a couple pictures. So if you've got your Flat Kurt, go and take pictures for us. We give $50 to the charity every time you do that. And then, of course, we have our ambassador program, which I'll show you some pictures of as well. But we always love meeting people that we might be able to help that you know. So, please pass along this video or, have them go to one of our classes or something like that, because there's a lot of people we can help. But these are different organizations we've helped in the past, and we have a new one for this year based on a client suggestion. So we are going to be supporting 5 Points of Hope, which is, we always love supporting a local charity. So this is a Michigan-based charity, helps families pay for cancer bills. So this is where all of our donations will be going to for this year. So we're excited to have them as our charity of the year. So very good. Here's some other charity things we did. This is our gift wrapping that we do every December for the foster kids. So if you're ever able to make that, I know it's a little bit of a hike because it's out in Sterling Heights or wherever it is exactly. But this is always a fun thing to do. We do for Friends of Foster Kids. We wrap gifts for foster children. So it's a fun thing to do. If you haven't done it, then come out and visit us sometime to do that. Then we went to Forgotten Harvest and did some food sorting and different things like that. So we're going to continue doing those. And then we had the Thanksgiving parade. And if you got to do that, I missed this one, but I hear this was a pretty cool event, helping with building the floats and everything. And people had a lot of fun with that. So all good causes. Here's this year our ambassador event. So our ambassador club is anyone who's introduced us to someone that we've been able to meet with and talk to. So our ambassador, which is as a thank you, we always do a nice dinner. So we did it at the Whiskey Factory this year, which is a really cool place in Detroit. Cool experience, and we got to do a little tour here of the whiskey makers, and there was a big Spartan fan there who was giving the tour, so he talked a lot about that and how his friends started the company, which is pretty neat. We also did, Marcia had a nice little challenge here, which was a whiskey bottle full of change, and there were some hints as to how much money was in the change, or how much dollar value was in this whiskey bottle, and we had to try to guess how much money there was, right? So that was kind of a fun little thing. So, who was our winner? Well, we had Murray C. He guessed $43.67. Okay, the actual answer was $40.89. So he was pretty close there. Now, understand, I'm pretty competitive. You might have learned this about me in the past. So I really wanted to win, even though Marcia said I was not allowed to win. So there's never second place, right? But I do have to say I got second. But there is an asterisk by this because we've been talking a lot about asterisks this year and whether they count or not, right? Yeah, I actually had it written on my little card, $40. And then I thought that was too low, so I moved it to 45, and I just lost. But this is Murray. He's our big winner. So looking like a dapper gentleman here with his whiskey bottle that he won, and with the barrels here. So I love that picture of Murray. It's great. So yeah. Okay, so I said I'm competitive. We have a Wealth Track softball team, if you haven't heard about this, that we play every year. And we always end up second every single year. Well, this year we finally pulled it through and won the championship again. So this is our team. We had a big contest on the day before. Actually, the semifinal was a big game, and Neil had a big hit to win that game, and when we were down to our last out. So that was pretty cool that he. Admittedly, it's actually just me and Neil that are on the team from the company, but we had to bring in reinforcements from other sources. But yeah, we won our softball league this year, so that was fun. And then we've got Pinewood Derby coming up, so it's Pinewood Derby time of year. This is last year. That's my friend Craig setting up the cars, and you see the cool Spartan car we got there. This was Mason's car last year. Very patriotic. This is what he wanted to do, red, white, and blue, and then we got some stickers for him. So here's our little video. I don't even know if this will play or not. Here we go. If you haven't seen Pinewood Derby, this is it. Mason's on the right. Yeah. So Mason got second place in his little den for all the kindergartners, and then we got sixth place in the pack last year. So currently working on, and by the way, that's Dylan has a very good track record where he got fourth in the pack, then third in the pack, and then second, and then we got third in the pack. So, but Mason's only sixth, so we're working on getting closer. I will show you, this is this year's car, where it is so far. No wheels yet, but that's it. You'll see that we've got this little interesting hole here. It's because I accidentally drilled through. So admittedly, we made that, I was putting in the weights and I drilled right through and I was like, okay, well, we're going to use this to our advantage, right? So we got kind of a cool, we decided to do a cool little lightning bolt off it, like it's coming, it like got hit with a lightning bolt. And we're taking suggestions for names. So if you've got any cool names for our lightning car, I told Mason, I was like, you can't just name it lightning car. That's, it's got to be something a little more creative than that, okay? But here's some recent adventures from Flat Kurt. So we've been off to the Caribbean Islands and Amsterdam, thanks Mike, and Marcia took us to Athens and been in the Badlands. And Mark, thank you for your picture here for driving out to, that was Montana? Yeah, cool, on his motorcycle. So yeah, so if you got your Flat Kurt, take them on some adventures, and we always love getting these. They do contribute to our charity that we give to, $50 for every picture. So yeah, it's fun. Of course, if you haven't seen my TV show and you're up early on a Sunday morning, then go ahead and tune in or DVR it. But yeah, I'm on Channel 7 in the morning, so on Sunday morning, so catch that. So just a couple pictures of that. And then, okay, so can anybody guess who this is? Anybody know who this is? Yeah, Charlie Munger, okay. So I was gonna, if people didn't know, I was gonna give some hints. So one hint I was thinking of is, he died like 35 days prior to his 100th birthday. Charlie Munger did, toward the end of 2023. And the other clue I was going to give is he was a dropout from University of Michigan. Because he actually went there for freshman year. He didn't really drop out. He ended up going to like the Peace Corps or something like that. So I think it was a worthy enough switch. But just I wanted to mention Charlie Munger because I think he's a pretty phenomenal person just in general. If you've ever read about him or know anything about him, he's basically Warren Buffett's right-hand man, Charlie Munger. And the accolades that Warren Buffett will give to him are incredible. Basically, Warren Buffett would say, Charlie did all the work and then he would let me take all the credit, is basically what it was. So Charlie Munger was kind of behind the scenes there with building Berkshire Hathaway, and while Warren Buffett was the face of the company, which admittedly, when I look at our staff, this is the way I sometimes feel. They do such a great job for us, and I might be the one that sort of gets the credit here for doing a good job, but I couldn't do it without all these people. So, they mean a lot to me. But Charlie had an interesting quote that I wanted to share with you, just as something to kind of think about, because I thought it was pretty profound, and you can think of this in a lot of different ways. But he said, all I want to know is where I'm going to die. So I'll never go there. Now, this can be funny, obviously, right? But there's a lot of elements to this, and actually, one of the things that I take as a takeaway from this is the way that what he was really talking about is when you're investing, you can't always know the exact right thing to do, okay? Don't try to get it perfectly correct, okay? It's more important to avoid the things that are going to hurt you. And that's the challenge, is figuring out what are those things that we need to avoid, okay? So that's where I thought this was pretty profound as a statement. So I figured I would share with you. So good. So I hope that was a good educational little summary there for this year. So the year of euphoria. Let's all enjoy it while we have it. And, we'll come back and see where we are next year with some new economic data. But, hope everybody got some great information. And, actually, we'll take a couple questions if we've got any, just to kind of jump on here. Yeah.
Well,
Yeah, Tom.
You think that the smaller stocks are going to do better this year than the big stocks?
Yep, so the earnings.
Do you plan on adjusting everyone's portfolio?
So that within the portfolios, yes, that's what's basically what it's trending toward. Yep, is that it's going to smaller companies. Mm-hmm. Yep. Yep.
What's going to trigger that specific?
What do you mean?
Why the rollover? I mean, what's the
Oh, you mean why are the smaller companies going to do better?
yeah.
Because smaller companies trail when things go well economically, they take longer for them to recover generally than larger companies. And declining interest rates take a little while for those to assist the smaller companies. So that's why that's basically what the trajectory shows, along with the larger companies not being able to have as good of earnings growth as they've had in the past. So it's a little bit of a combination of both. Yep. Good. I wanted to go about an hour, so we're at about an hour. And thanks everybody for coming. Glad we had a full house today, and thanks so much. Thanks.